Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kostrup Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Rob, great to be back with you this week. How are you doing? How was your summer?
Yeah, it was really good. I took one of these long European holidays that Americans are so jealous of, so I've been kind of mostly off since mid-July, but with doing odd days since. Had done some traveling, had some sunshine, had some rain, a bit of everything really. So yeah, a very pleasant break. And I think when you've had a good break when you're really struggling to motivate yourself to do anything when you get back. So that's where I am at the moment. So
yeah, although I will say I think most Europeans would also be envious of your long holidays because I'm not sure we all get that kind of holidays.
No, my vacation is European plus, I guess you could call it. Yeah,
you combine it. Yeah, fine.
Exactly.
Okay, good. Well, we've got quite a few questions that came in over while you were away. We've got kind of a variety of topics we want to discuss today, which are maybe not the usual ones. And then also, as we always like to do, is to talk a little bit about what's kind of been on your radar, what's caught your attention outside what we're talking about today. And I normally say since we last spoke, but it's been so long, so I'm sure it's more recent than since we last spoke.
Yeah, I mean, I guess like most people in the industry have had a pretty torrid few months in terms of performance. So I kind of had a high watermark in late May or April, I think it was, the last few months have not been very good. So I'm kind of flat for the year in terms of my own performance, and in terms of my current risk, which I think is probably more meaningful than looking at what's gone in the past in case people are interested. So I'm currently long equities, long bonds, and short some sort of gas and agricultural markets. So perhaps I've kind of got almost like a risk parity portfolio, I suppose, if I'm long equities and bonds. So that's a portfolio that's kind of positioned for a particular kind of macroeconomic outlook. So we'll see how it goes.
We'll see how that goes.
As I say, also running quite low risk at the moment, which is what you'd expect in the middle of a drawdown that, models struggling to find strong forecasts in a lot of markets. So running at quite low risk.
Yeah. Now, you could have chosen any topic that might have been on your radar. You chose to talk about your own performance. And my follow-up question to that is...
Yeah.
I know when you go away, you let your systems run, and to me and many maybe to other people, that sounds like a scary endeavor just to let it run and do the trades and all of that. I'm sure you get reports along the way, but July and August were interesting months, generally speaking. I mean, there were some pretty huge moves. Did you feel differently this year leaving the systems on, or have you now built so much confidence, having done it for many summers, so to speak, that actually this was no different to any other summer?
Yeah, I mean, I've gone away in the summer and had really good months and come back. And although I do get reports sent to me by email to me, to be honest, I don't really look at them. The fact that I'm getting the reports means my system's working, so I kind of relax really. And also because there's not really anything I could do if something was going wrong, apart from, I guess, manually log onto my futures account and close all my positions, because my server's not a cloud server, so it's running on a home machine. And although I probably could think of a way to do some kind of remote access, I've never really got around to it. And so yeah, I guess I have enough trust in. I mean, it helps that it's my code, I've written it, it's my trading strategy, I understand everything that's going into it. I think, and it's my money. It's my choice what I do with my money, right? So it's not like I've got other people's money and I'd have a fiduciary duty to kind of look after it properly. And I guess most people would be quite upset if they gave me some money and then went on holiday for a couple of weeks and just left the system running. So yeah, I mean, I'll be honest with you. I don't like losing money. I don't think people do. I don't like being in a drawdown. I don't think most people do. This drawdown's probably about as equal as the worst drawdown I've had before since I've been trading in the last 10 years. So it's like, it's not ideal. But it's probably easier in some ways to kind of leave your system alone if you're not there, right? So the big temptation when you're losing money is to change your system and change your strategy and fiddle with things and think, oh, have I missed something? That's obviously quite a lot harder to do when you're sunning yourself in the south of France as I was. So yeah, it's one of those things. I do find that the longer I'm doing this, the less and less attention I pay to kind of day-to-day market noise, to be honest, unless it kind of reaches the main headline news. So actually, when I was on holiday and somebody said to me, have you heard about Bayesian? I'm like, oh yes, it's one of my favorite methods of statistical methodology. And I sort of started talking and they kind of looked at me like I was mad. They're like, no, the yacht Bayesian, which of course, as everyone knows, is this super yacht that belonged to Mike Lynch, who's a founder of autonomy that sank in this freak storm in Italy. So that was like the only time I even had any conversation that was even tangentially related to what I do for a living, and that, and that was about the Bayesian. So I've actually had to explain to quite a lot of people what Bayesian actually is now, because quite a few people are curious as to what actually is Bayesian. What does it involve? And weirdly, actually, and coincidentally, yesterday I was actually walking past the graveyard of George Bayes. He's buried in the city of London, and in a graveyard, and I was actually walking through it. And I thought, there he is, the man himself. So if any listeners want to hear more about Bayesian statistics rather than Bayesian yachts, obviously I'm an expert on both because I'm a sailor. So the sinking of the Bayesian kind of ties into two of my kind of key interests. So, but yeah, that's the only kind of sort of significant news that filtered through to me. I mean, this might sound crazy, but we had a bit of political instability in this country, and there were actually riots in the street across the whole country. And I didn't know there were actually riots in my hometown where I lived until someone told me. I didn't know it was going on. So that's how detached and disengaged I can get from the news that's going on when I'm on holiday. But even when I'm not on holiday, I kind of glance at the headlines in the FT and read bits of pieces. But I couldn't tell you, I only know, for example, that the US yield curve is just disinverted. So 10-year yields are now above 2-year yields, which is the kind of quote-unquote correct way around, because somebody sent me a message about it. Otherwise, I would have had no idea that happened. I like to think of myself as a very kind of purist, sort of purely systematic person who, and I'm trying to achieve that goal, and I'm not quite there because I do still worry and think about losing money and about maybe I should change my system and so on and so forth. But I've got quite good at detaching myself completely from what's going on and just letting it run.
I think a really important point in what you just said for our listeners is actually the level of dispassionate view on systematic trading you've achieved, and I think that only comes with experience. And I actually also think that a lot of people, when they hear the fact that you can really kind of log off, so to speak, for a while, I think that's in definitely short supply, and a lot more people should do it, probably myself included, and that it would be much better for our mental state if we could take these true breaks. So yeah, no, I appreciate you sharing that.
Yeah, and one thing to say actually is, I think it is experience with me, because I don't think I'm one of these people who naturally could do that. So I think that some of the best discretionary traders are those who are able to look at markets very dispassionately without any emotion, and really detach themselves and have kind of analyze what's going on. And I'm not. I can't do that. I do, or certainly when I was trading in a more discretionary way, I used to get very emotionally involved with what was going on. And I think that's why systematic trading suits me and probably most people out there better than discretionary, because I think the ability, a natural ability to kind of withdraw yourself from the market, especially if you're not trading in an automated way, is extremely hard to achieve.
Yeah, no, absolutely. My thought of what's been on my radar is not nearly as interesting as yours, because I was thinking about the U.S. unemployment data that's coming out in about an hour or so from from when we are recording. And the reason I was thinking about that and why it came up to my attention is really that I think today's number might really be the one that will set kind of the trajectory for the rest of the year for the Fed. So in that sense, it's important. Interesting to note that a lot of the economic data that we had leading into April of this year was kind of, giving them reasons to keep rates where they were. And then since April, unemployment numbers have been a bit soft, and now everybody is speculating in terms of how much they will do, and that number seems to change a lot. I think it might change again today. We'll see, but I wouldn't be surprised if they just do 25 basis points at each of the next 3 meetings or whatever they have left. That would be, not surprising the market. So we'll see. We'll see how it all pans out. Oh, yeah, and by the way, the other thing I thought of is that I think that maybe next week we have the first debate between Harris and Trump. That might also be quite interesting.
She's fine. I thought you and I agreed there was no politics in this episode.
I just said there's a debate coming. I didn't say one way or the other.
You're not expressing your preference. Okay, fine.
Okay, good stuff. All right, before we dive into the questions and the topics, just the latest update from trend following. We know how you fared. You can expand on it in terms of what you think is going on. From my point of view, the first week of September, obviously a lot more quiet than the first week of August, for sure. So far, I think the major themes has been that equities are down in price, but they're also hurting trend followers whilst heading south. Bonds are up. Most likely that's going to be helping trend followers at the moment. And then maybe one other sector that is becoming kind of meaningful in terms of exposure for many trend followers would be the grains. They've corrected upwards for the last few days, and that's probably not to the liking of trend followers who are, on a sort of a downtrend at the moment, position-wise. The other thing I thought of, and maybe you've seen the same in your system, and I don't recall exactly how you do it, but I do think August may have been a month that trigged a lot of risk reduction overall in CTA portfolios, not least because some markets and some of the bigger sectors flipped direction, and that leads to changes in correlations and went from a risk management point of view. So I think that could also have been an interesting little outcome from the month itself. Does that kind of sound reasonable in your mind, looking at how you're doing?
Yeah, I mean, as I said, you basically reduce risk for 2 reasons. One reason being that the trends are turning against you. Actually, 3 reasons. Apologies. One reason is the trends sort of turn against you, and that might be because you've got a continuous forecast like me or a stop loss system, like a more traditional system. Second reason why is you'd reduce risk is if volatility increases. Again, this only applies to people trading in the way that I trade. But if volatility spikes, you'd reduce your positions. And the third reason is, if you're just losing money. So all the things being equal, if you lose 10% of your equity, and we can, some people do close trade equity, some people do open trade equity, but if you lose 10% of your account value, then you should reduce your positions by 10%, even if nothing else has changed. So I guess in August, we'd have seen all 3 of those things coming together. So yeah, I would have expected to see risk reduction, and certainly that's what I've seen on my system.
Okay, cool. All right, well, from my point of view, my trend barometer, which by the way is back online on the website for those who've missed it, it finished at 50 yesterday. So that's actually a pretty good number. So maybe, Rob, it's time to consider buy the dip of your drawdown. You never know. But it is actually a good number. And I think yesterday was a little update for CTAs. But as of Wednesday, BTOP 50 for the month of September now, down 0.25%, up 2.5-ish for the year. SocGen Trend Index down 35 basis points in September, up just shy of 1% for the year. SocGen Trend down 34 basis points, very similar, and also up about 1% for the year. And the Short-Term Traders Index, obviously enjoying maybe a little bit better conditions, up 64 basis points and up 10 basis points for the year. In contrast, the traditional markets, MSCI World down 2.56% for the month of September. As of yesterday, up 12.57% for the year. The S&P Global Development Sovereign Bond Index, it's such a long title, is up 78 basis points, down 2.2% for the year. And the S&P 500 Total Return down 2.57% and up 15.38% so far this year. All right. Before we get into the topics, we have a few questions. Some of them are quite long, so I hope I don't butcher them up too much. First one is from Louis. Louis says, "Thank you for sharing your knowledge, experience, and developments for the community. You are a great inspiration to all of us." That must be you he's talking about here, Rob.
Obviously.
I have a question regarding the paper series, A Half Century of Macro Momentum from AQR. I attempted to implement the various macro momentum signals described in the paper using Rob's methodology. This involved creating different forecasts for macro factors like growth, inflation, monetary policy, risk sentiment, and international trade. I applied these forecasts to all the futures markets I trade, about 100 markets, and obtained results comparable to those published in the paper. However, I was very disappointed when I ran the backtest of the price trend plus carry plus macro momentum strategy and found that the total Sharpe ratio was worse than the original system with just price trend plus carry. The system is much more complex and depends on data that is difficult for a retailer to obtain, yet it has a lower Sharpe ratio, although it's probably a more robust system, he writes. I was wondering if you had tried to implement something similar in your system. What are your thoughts on macro momentum for retail traders? What would you do in my position? So, of course, I'll pass it on to you, Rob, but just want to add, of course, Louis, that it's not going to be investment advice Rob is going to talk about, but he's going to try and answer your question nevertheless.
Rob never gives investment advice because Rob is not qualified or certified or regulated to do so. So that should always be very clear. So macro momentum is a very interesting idea, and I have a lot of sympathy with the sort of underlying theory behind it, which essentially is that there's a bunch of latent factors in the world that you can't see. And when we do momentum, all we're doing really is doing momentum on individual markets that are kind of sort of effectively what we can see of those latent factors. The factors are invisible. We can't see them directly. We can't observe them directly, but they form trends. And by trend following individual markets, we can kind of get that to work. And one thing that supports that theory is that if you do momentum just at an asset class level, so you kind of put all the bonds together, all the equities together, and you form a kind of synthetic index, you find that actually captures about 80 to 85% of the P&L of trading the individual markets. And the rest is effectively like a relative momentum across markets. So that kind of supports that idea. So the AQR theory is that the macro factors are a more sort of true version of these underlying factors, or maybe just an alternative set. We could trend follow those instead. So it's a nice idea, but obviously it's a lot more work because you need a lot of, I've not implemented this specific system, but in my olden days at AHL, I did implement a global macro system, so I have experience of collecting macro data and analysing it, and it's obviously more expensive and time-consuming, and there are issues with it, which we won't go into today. But I think the best way of addressing this question is a very abstract sense, which is to say the following. I've implemented a system A, but which has got a good Sharpe ratio in backtest, but when I add it to another system B, the Sharpe ratio drops from 1.3 to 1.2. Should I add system A? That's basically how we can summarize this question without getting into, macro momentum or the details behind it. Now, the answer is, well, it depends on a few different things. So the likelihood, why would a Sharpe ratio fall when I add something onto a system? Well, it's probably because it's got a lower Sharpe ratio than the thing that you're starting with, but the diversification benefits of adding it are not sufficiently high to overcome that. Okay, so you can boost Sharpe ratio in two different ways: by adding something that has a higher Sharpe ratio than the original portfolio, or something that has a lower Sharpe ratio but has got a very low correlation or even a negative correlation, and that will bump up the Sharpe ratio. My suspicion is that macro momentum is quite correlated with price trend, sort of what we do. Because as I said, I think they're based on the same underlying idea, which is these latent factors. I don't know what the correlation is off the top of my head, but I'm guessing it's not like zero, or probably adding this strategy in would have improved the Sharpe ratio. That would be my guess. The other, sort of in general terms, a Sharpe ratio fall from 1.3 to 1.2 isn't necessarily a deal breaker, because that's not a big amount. So, in general terms, when I'm adding stuff to my system, I don't look too closely at the Sharpe ratio. I look more at the correlation. I look more at whether it's adding something different to my system. So my prior would be that macro momentum's probably a bit different from normal momentum and worth putting into my system a bit. Not 80% or something, but a bit. But I wouldn't necessarily look just at the Sharpe ratio to sort of determine that, because getting into statistics for a second, Sharpe ratios are a lot more variable and harder to forecast, and have got a lot more dispersion in backtests than, say, correlations, which are more stable. So look at the correlation, and if the correlation between these two things was like 0.4, then yeah, I'd probably add a bit. I'd probably think that's worth adding 5-10% to this, even if it does reduce the backtested Sharpe ratio, because I've kind of got more faith in the correlation and the diversification power than necessarily the Sharpe ratio being a bit higher or lower. If, on the other hand, the correlation is like 0.8, 0.9 between, say, macro momentum and price momentum, I'd be kind of thinking, well, I'm happy personally to add things with a correlation of 0.8, 0.9 to my system, but not if it's going to involve a huge investment in all of this extra work. I'll be asking myself whether it is really adding value. So what I would basically do is go back, look at the correlation between macro momentum and price momentum, and if that seems, quite high, I'd probably put the whole thing on a back burner and say, this is a lot of work. It's not really going to add, it probably will add a bit of value with a small allocation, but it's not worth the extra work for an individual investor. For a big fund, sure, yeah, because, they can throw people at the problem and it's worth the extra value. If on the other hand, you see a low correlation, then it may well be worth doing.
Yeah.
Who knows?
And it may also actually improve drawdown profiles, et cetera, et cetera.
Yeah, it's not just about Sharpe ratio.
Yeah. Okay, cool. Now, the next question is from Roman, also related to something that you've done. He uses some short, well, I don't know what it's called, but you will be able to translate this, I'm sure, for us. He writes, in the AFTS book, Robert introduces the IDM and the FDM multipliers to target portfolio volatility by applying his concepts to 30 different instruments divided into 6 asset classes. I've introduced 2 additional multipliers to account for the existing diversification among the strategy classes and different strategies within each class. Is this an appropriate approach? Are there any other methods to efficiently target volatility?
Very briefly, the IDM and the FDM, the idea is that when you combine a bunch of return streams with a certain target standard deviation, that's the way I build trading strategies. So you might say, well, I'm going to target 25% standard deviation. Say I'm doing it across markets, I throw in 150, 200 markets. I'll find that my volatility drops from 25% to about 8%, because that's how much diversification I get with 300 markets. Even with just 2 markets, I'd probably find, unless they were very highly correlated, I'd find my standard deviation dropping from 25 to 20, 15%. To account for that, I include these multipliers. What they basically do is effectively multiply everything up again, so I hit my standard deviation target again. And I do that in 2 different places. I do it when I combine different forecasts or trading rules, if you like, for an individual instrument. So I might have, 6 momentum predictors, 3 carry predictors, and so on and so forth. I combine those together and I look at what the effective diversification is, and then I account for that by applying this multiplier, so that sort of individual little system that's just trading one market has got the right volatility target. And then I do the same thing at the across my instruments. So I, could throw in the S&P 500 trading strategy, the US 10-year, and so on and so forth. And I see what multiplier I need to apply there. So that's what those abbreviations mean. That's what they are. Now I do that. What he's suggesting is doing that in a couple of other levels. So basically what he's suggesting, I think, is to say, okay, well, I'm going to have, say, 6 different ways of doing momentum at different speeds. I'm going to combine those, and then I'm going to apply a multiplier. And then I'm going to have some carry systems. I'm going to combine those and apply a multiplier. And then I'm going to put momentum and carry together and apply a multiplier. So he's sort of doing the same thing, but at more granular levels. So I actually do a similar thing myself in my portfolio construction, but I don't call it that, if you like. So I do my portfolio construction in a hierarchical way. I do put together my momentum signals. And what I then do is, rather than applying this multiplier, let's say I've got more internal diversification and more momentum signals than I have carry signals, what I do is give a bigger risk weighting to those momentum signals. And that's basically exactly the same as the approach that Roman's using. It's just that I call it a different name and it happens in a different part of my system. So to 80% of the people listening to this podcast, they'll be like, what was that? What was that? But that will answer Roman's question, and also anyone who's listening who's familiar with the way I construct portfolios will answer the question for them as well.
Good stuff. All right, last question is from Joshua. He writes, I'm a new listener to the podcast about 2 months in and have devoured hours of content. Thank you for the wonderful show and all the great teaching moments. I had a question for you and your guest. I have a small account under $10,000, have 29 future instruments that I follow for diversification and 2 trend following systems I've tested. A medium and long term. Due to my account size, I only trade 1 contract and they are most mini and micro instruments. My problem is with risk management. Initially, I only wanted to risk less than 2% of capital on each individual trade. And when I tested using a volatility-based stop, 2, 2.5, or 3 ATRs, I would be risking 5 to 7% of capital. I began trading with a 2% risk, but I often bounced out of positions after a couple of days of it going my way and then a slight pullback. This has led to multiple small losses that have added up when in reality the instruments haven't really gone anywhere, and with an ATR stop I would still be in the initial trade and not to exit and just renter as I have. My question, for a small account like mine, should I base my risk management on ATRs versus actual percentage of capital? Meaning I focus on using 2 or 3 ATR stop, though it would be a 6% capital, 6% of my capital. I've heard many of your guests talk about doing the right thing, even though it's uncomfortable. I'm just not sure what the right thing is in this situation. Losing money prematurely and taking a bit larger risk on a percentage capital basis. Any advice would be greatly appreciated. Joshua, again, obviously no investment advice from here, but some thoughts at least on this particular issue.
Yeah. So I don't actually use stop losses or ATR stop losses in my own system, but I have written about them, so I have sort of understanding of the problem that he's sort of like driving at. Basically, I think the problem with a stop loss in the way that most people think about it is it's effectively doing 2 jobs for you. First of all, it's determining the sort of amount of risk you have on per trade, which is sort of determining your overall risk, if you like. But it's also going to tell you how long you're going to be in your positions for. And it's this confounding of the 2 things that leads to this problem. Because it does seem like you've got a binary choice between either having huge risk and letting positions run for longer, or having a tight risk and risk them being prematurely closed. And the solution is to completely get yourself out of this mindset. And I've written a series of blog posts on it, so I won't go into massive detail here. Joshua, you can Google my blog and see for yourself. But basically what you want to do is completely separate out these 2 decisions. So one decision is, how big should my positions be? And the second decision is, how long should I hold my positions for? And this is nothing to do with and the other thing about doing it this way is completely abstract from what kind of trader you are. And it completely depends on which market you're trading as to what speed you want to trade and so on and so forth. So you can completely abstract all our way. So in my one of my books, I actually kind of put together a system that does use an ATR stop. And from memory, I think it's something like an 8 ATR stop. And that's quite a slow system. That's a system that's going to be holding positions for about 3 months. And the reason I do that is because the book's aimed at retail traders who are often trading instruments that are quite expensive to trade. So maybe futures, probably you can trade a bit quicker. So he could probably use a slightly looser stop. But, so he talks about 2.5, 3 ATRs. Yeah, I mean, 4 ATRs, something like that's probably about right. I don't have the numbers in my head, but I think 4 ATRs would give you a holding period of about a month, which is kind of hand-waving, sort of typical average CTA futures holding period. So it wouldn't be too far wrong. Go much tighter than that, then you're no longer sort of in the medium speed momentum trading world. You'll become a short-term trend trader, which is a whole different ballgame and a different set of expertise. So the ATR set at, say, 4 ATR. And then what you want to do is actually size your positions according to how much risk you should be taking. And that's, again, it's not just a pure percentage of capital. There's a lot of factors that go into that. Go and look at my blog post to see that. But basically, what happens is you increase the ATR stop is you do take more risk per trade, but because you're taking fewer trades, your actual overall risk stays the same. So these 2 factors counterbalance each other. So you shouldn't be concerned about the fact that it looks like you're taking more risk. Actually, you're taking less risk than somebody who was putting, say, 2% of their capital in, but only using like a 1 or a 2 ATR stop, because they're going to be doing lots and lots of these 2% trades, and they'll be actually, their risk will be much bigger, which means if their trades go wrong, their drawdowns will be much larger. Their annualized standard deviation returns will be much bigger. So that's the problem with this kind of mindset that people have, that it's, it's an ATR stop and it's this percentage of capital and therefore I'm risking this much. You need to separate these things two things out in your mind. Just go and look on my blog and there's a series of posts there that explain it. Or even better, buy my third book, Leverage Trading, which also explains it.
I think definitely, Joshua, you should buy Rob's book. I will add one thing, and it's going to be maybe a little bit surprising for people listening to the show today, because I would maybe consider, Joshua, given the fact of your account size at the moment, is actually maybe to say, okay, until I have more capital, I'm going to buy, say, an ETF that tracks a CTA index or one of the single manager CTA products out there, and then just save up a bit of more cash to get you to a point where actually some of these issues may be dealt with in a better way as well. It's very hard to get that level of diversification on an account size of $10,000. So I'm just going to throw it out there and say there are third ways, so to speak. But by all means, I'm impressed with the level of detail you've gone into for your trading system, and just keep developing it, keep learning about it, keep running it, and get more comfortable with it. And from there, you could probably also work out what would be a good account size to start off with. And in the meantime, let someone else do the heavy lifting for you.
Just to reinforce that, I mean, I think I say you probably should be looking at least $100,000 to trade a diversified portfolio of futures, because even if you're just on the micros and the minis, those aren't available in a lot of asset classes. So it's most likely that your portfolio will be dominated by equity indices and agriculturals, where there are a lot of micro contracts. There's much less liquid contracts in the other asset classes. So it's really hard to get diversification without at least, I'd personally say at least six figures.
Yeah. Okay, cool. All right. Well, now we're going to jump on to some completely different things, because these are the topics that Rob brought along, and very interesting. I don't know much about some of them, but I'm always in safe hands when I'm guided by you, Rob. The first one it's about Bitcoin. It's about this idea, as far as I understand, that Trump has talked about. He wants to create a U.S. strategic reserve of Bitcoin. Some people might think that's a good idea. Some people might think that's a terrible idea. Tell me why you wanted to talk about this particular topic.
Well, I think it's fair to say that the people who think it's a great idea are probably people who are long Bitcoin. That would be my starting point, because obviously if the US goes and buys an absolute ton of Bitcoin, then the price is going to go up. And even the expectation that potentially even Trump floating this idea has kind of probably bumped up the price of Bitcoin. And and now I think Bitcoin's going to be quite really high correlated to Trump's chances of winning. Right, we're probably going to see the price go up if he. So that's a nice proxy if you want to bet on Trump winning. Maybe just buy Bitcoin. It's kind of interesting to me because it does go back to this debate about why should Bitcoin exist? What the point of it is, and I want to rewind it back to the kind of, because the first initial idea as to why Bitcoin should exist, which is effectively as a form of money, right? That seems to have fallen by the wayside. Like it's, I think most people agree now, it's just a purely speculative asset. But if you're going to have if you're going to have a sort of US central bank holding Bitcoin in its vault, so to speak, in a metaphorical sense, as a reserve, in the same way that all central banks hold other currencies in their vaults for various reasons, for example, to try and control their exchange rate a bit, if they can, potentially. Or to help with cross-border payments and just to diversify their balance sheets. There's various reasons why central banks might want to hold assets. And of course, central banks also hold gold as well. So you could say, well, maybe Bitcoin's a bit more like gold, and maybe it's just a way of diversifying the Fed's balance sheet. I don't know what percentage of the Fed's balance sheet is gold. I think it's probably quite a small amount, to be honest. I don't have the figures at the top of my head, but I expect it's not a significant percentage anymore, compared to say 50 years ago. So maybe if they just kind of add a little bit of Bitcoin to their balance sheet, the same as they have gold, it's not going to change the Fed's balance sheet very much, but it may potentially change Bitcoin's price quite a lot, because it would be quite a big flow of money into the Bitcoin space. But if it's there as money, if ultimately the idea is that it's money, then it seems like a pretty. I mean, I know we aren't going to get into politics, and I'm not going to kind of say what my opinion is of either of the candidates, but it seems like a pretty dumb idea, I'll be honest with you. Because the US dollar has, all currencies, but specifically the US dollar, have this amazing characteristic for the government. The first is that the government can make as many US dollars as it likes. The second is that the government can make people pay their taxes in US dollars. They don't accept anything else. Sometimes they'll accept, in kind, but basically you have to give the government back its money. Not everyone agrees with the MMT people, but one thing I think they're right in saying is that, when people moan about paying taxes, well, actually, you're just giving back the government the money that it created. Okay, so it's not your money. The money belongs to the government. The government created it. The government controls it. What the government's actually doing, of course, when it charges you a tax, essentially is saying all the sort of productive work you put into the economy this year, which, as it happens, is denominated in this currency, we want to take 10, 20, 25% of that to provide you with services and also to redistribute income. That's what taxes do. It just so happens it's denominated in this currency and we use this currency to do it. But you can imagine a barter system where we still have governments, but where, and this happened hundreds of years ago, where you'd have had to have brought 2 of your cows and given them to the high sheriff as your tax payment. Now I guess you could think of a system where you let the government just have a percentage of your hedge funds there as their tax, so it doesn't have to be cash transfer. It could be barter in principle. The money is just a way of keeping score and keeping count. And one of the reason I mention this is when I sort of first started looking at Bitcoin and being very critical of it, frankly, is one of the reasons why I said, well, this will never work, is because there's no way any government would be crazy enough to say, oh yeah, well, you can pay your taxes in this other thing that we don't control. We think that's a great idea. So it strikes me as one of the US dollar is a fantastic thing for the US as a country. The dollar hegemony is weaker than it was, but the fact that it's the world's global reserve asset, the fact that everyone has to kind of use it for trade and transfer and so on and so forth, the fact that it's controlled by them is a huge advantage of the country. To me, it seems completely bonkers that you even get close to frittering that away by saying, oh, actually, we're going to bring this other asset into the monetary system and we're going to kind of give it an official stamp of approval and we're going to buy in our reserve account and perhaps say, yeah, you can pay your taxes in Bitcoin, which is this thing we don't control. So there we go. It's a bit of a rant, but it's kind of an interesting one because it relates to the idea of what money is and the kind of the purposes of money.
Yeah. Interesting. A few thoughts. First of all, by the way, I guess the US could buy up all the Bitcoins because the market capitalization is only about 1.1 trillion. So, they can just add $1 trillion to the balance sheet, which is down from like 9 to 7. So they can take it back to 8 and buy all those. So that's one solution, of course. But the other thing, no, more seriously, I agree with your idea that if people think that Trump might win, it would be bullish for Bitcoin. But actually, what's also interesting is crypto and Bitcoin and Ether haven't done very well in the last period of time. Made highs in March, I think, and I think Ether was down 22% in August, and Bitcoin is down as well. So I don't necessarily see that anticipation and demand, even though the chances of a Trump victory is obviously real. That's one thing. Offsetting that a bit is that I read an article just this morning where it talked about how hedge funds and institutions are embracing Bitcoin ETFs. And it mentions that most, and I'm quoting now, most institutional investors who allocated in Q1 either held or bought more shares this spring. Among Q1 filers, 54% increased their position in Bitcoin ETFs in Q2, 22% held steady, 21% decreased their position, and 13% exited from this. So there are clearly, some people who still think it's a good idea to hold it as a part of their portfolio, but it's not really reflected in the prices at the moment. On the other hand, gold is making new all-time highs.
Indeed. Yeah, so maybe they should just buy a bunch of gold instead.
You never know. But the good thing is we're going to be talking about ETFs now.
Yay.
So
we are.
So where do you want to go with the next topic, which is about kind of actively traded ETFs, I think?
Yeah, so there's a lot ETFs obviously are a big thing, and I think in most people's minds, ETFs are the kind of core passive part of your portfolio. So most people, I think most people still use ETFs to get exposure to, say, the S&P 500, the MSCI World, or the, whatever the very long name of the bond index is that you choose to mention. Why are there so many global bond indices, and why with such long names? It's funny how there's no MSCI World equivalent in bonds that what everyone uses anyway. That's kind of, I guess, what people's minds, what an ETF is and what an ETF should be for. Even though, for example, Vanguard, who are the big people who are in the vanguard of passive investing, see what I did there, were actually quite slow to come to the ETF party. It's not necessarily like a one-to-one correlation with passive investing. And of course, there are ETFs now that do other things, some of which are very, very, very far away from the idea of a sort of passive long-only holding. So a few stories kind of in the ether, in the mix at the moment. So one is that the actively managed ETFs have now hit apparently $1 trillion. $1 trillion always sounds like a big number, right? Like, it sounds like an awful lot of number until you then convert that into a percentage of actively managed asset. And or of the ETF universe, and it's not a big number then. It's off the top of my head, it's probably about 10-15% of the entire ETF universe. So the ETF universe is still very much more of a passive thing. And then that sort of makes people, I think people need to kind of wake up and understand what ETFs are. Because I think part of the problem is that ETF has almost become like a brand. And people think, oh, this thing, but it's an ETF, so it's a bit like buying an S&P 500 tracker. So I'm not going to look too closely at the label. It's an ETF, so it's probably fine. It's probably safe. All ETFs are by definition sort of regulated. That's why people like crypto ETFs, right? There are a huge number of institutions that cannot legally buy crypto outright, or do not want to buy crypto outright because they don't want the hassle of warehousing it and worrying about and so forth. And they don't want to trade crypto futures for whatever reason. But they can buy any ETF that they like. It's listed on a major exchange. It's almost like a kind of shrimp around it with a stamp on it saying, well, amongst other people, the SEC is fine with you buying this. You can buy it. Doesn't matter what's inside, So it's a branding thing. It's also a regulatory thing that whatever you put inside an ETF automatically feels safe and nice and kind of good. And I think people need to be a lot more aware and careful, because actually all an ETF is a legal entity. It's an investment vehicle that works in a particular way. So let's rewind to before ETFs. And I apologize to people who are aware of this history, but I think it's important. There were basically two types of fund, open-ended and closed-ended. And they have different names in different countries. So for example, in the UK, we call our open-ended funds unit trusts, and in the US, they call them mutual funds. We call our closed-ended funds investment trusts in the UK. In the US, I think they call them closed-ended funds, so the name's quite accurate. But open and closed is the important distinction here, regardless of what kind of, American or British name you put on top of it. So the idea about an open-ended fund is, I'm a manager and I've got a whole bunch of, say, stocks that I own. Niels, you come to me and say, well, Rob, there's $500. I want you to add this to the account. And basically what I do is I take your $500 and I essentially say, right, well, this entitles you to this many units of my fund at this price. And the pricing is normally done on a daily basis. So, once a day, I'd say, this is how much my fund is worth and this is what you're buying in at. I take your $500 and I then use that to buy, basically a tiny bit more of each stock that I want to own. And if I'm a passive investor, that's quite straightforward. I'd obviously just buy a little bit of each stock, And if I'm an active investor, then I'd put it into whichever stock I felt like buying that day. And then you come back to me in a few months' time and say, Rob, I'm really sorry. I need to buy a new T-shirt because the one I'm wearing, I can't help noticing Niels is looking a bit tatty. Viewers at home can't see this. I need to buy a new T-shirt. There's a really nice designer T-shirt. I want some of my money back. I then say, well, this is the price. This is the mark for today. And I then have to sell a little bit of each stock to get the cash. In practice, it doesn't work exactly like that. For example, most of these funds keep a bit of a cash reserve so they can pay out investors coming in without having to redeem the underlying investment. So that's an open-ended fund. Closed-end fund works completely differently. Closed-end fund works like this. I launch on the stock market an IPO for, say, $100 million. And I take the $100 million I've been given by outside investors, and maybe I kick in some of my own money. Maybe I use leverage as well. I can do that. And I go and buy $100 million worth of stocks that I like. And, every day I come into the office, and if I'm a passive fund manager, I might have to do some quarterly rebalancing. If I'm an active fund manager, I'll have to, do whatever. But that pool of $100 million, that original pool of money stays static. Okay. And I can't, without going to the market, I can't get any more, and I can't get, also redeem. So you may ask how you as an investor can get into that unless you were in the original IPO, which is unlikely because it was probably only open to big institutional investors. Well, what you do is you take your $500 and you go to the market and you buy shares in my closed-ended fund, just like buying any other fund. And so you're buying those shares not off me, the fund manager. You're buying them off somebody else who already owns the shares already. And the price you're buying at, well, that's easy. That's a market price. These things traded in secondary markets. The price isn't determined by me making my daily NAV marks like it is with an open-ended fund. It's determined by a market price. And then, if you want to sell, you just sell again in the market. So the whole, this is sort of closed form, hence the name, closed pool of money that remains the same. Obviously, its value can go up and down. But if you want to kind of buy or sell, you do it in the secondary market with people who already own or want to get rid of those shares. So where does the ETF come into this? Well, the ETF is kind of an interesting hybrid of these two things. So most of the time, and to most people, an ETF works exactly like a closed-end fund. It's launched with a certain amount of money. And if you or I want to buy an ETF in the market, we go to the market, we get a market price, and we buy it if somebody wants to sell it. However, it is possible for an ETF to behave more like an open-ended fund if you're a big enough player in the market, and these people are called authorized participants. And what an authorized participant can do is treat the fund a bit like an open-ended fund, because they can come to the fund manager and say, okay, I want to put some money into your ETF, but, we're not talking $500 here, Niels, we're talking, $10 million. I don't want to do that in the open market because it's going to be messy. Your ETF's not that liquid. Instead, what I've done is I looked at the basket of shares that you own. I've bought $10 million worth of those shares. I'm going to give them to you, not as a present, not for free, but in exchange for an equivalent amount of ETF shares. So those $10 million of shares go into the ETF fund vehicle. The value of the ETF fund vehicle, the kind of market value, the market cap will increase accordingly. The price, of course, will remain exactly the same because it's price divided by number of shares increases, blah, blah, simple maths. And it's possible to do that operation in reverse as well. It's possible to take money, a big amount of money out of the ETF by basically saying, well, just give me the shares back, please. And then I'll give you the ETF stock in return. So it's a very nice vehicle because it has the immediacy and the ease of trading a closed-end fund for a small investor. But you have a no arbitrage situation because if the NAV gets out of line with the price, then big players will come in and take advantage of that with creation redemption, and that keeps the price honest. Whereas with a closed-end fund, it's perfectly possible, and indeed in the UK at the moment, it's a big problem for the shares to trade either at a big discount to the NAV or sometimes at a big premium. So that's all an ETF is. It's not actually a kind of special shrink-wrapped SEC-approved, this thing is definitely safe, because you can literally put anything into this thing, anything. And the stuff that people put, so you can put an actively managed ETF, that's fine. There are issues around the fact that the constituents of an ETF need to be known to do this authorized participant thing, and there's a way of getting around that a bit if you're an active investor who doesn't want to disclose your positions constantly. I'm not going to get into the details of that, but there's all kinds of other stuff in there, right? I mean, there's some stuff in there that So let's take an example of the probably one of the worst possible things that you can put into an ETF. And no, Niels, it's not Bitcoin this time, okay? So with an ETF, you can buy a single share. So it's not a basket of shares, it's just one share, okay? So you're thinking, well, surely you should just buy the actual share. Why would you need to buy the ETF? Oh no, this is triple leveraged. It's a triple leveraged share. So this thing is basically like owning 3 times the amount of money you put into the individual share. And there's quite a few of them. But one of the more crazy ones is MicroStrategy. MicroStrategy is this weird business that claims to be a real company, but actually is just a huge pile of Bitcoin. Okay, because the guy that founded this business thought, what his business model over the last few years has been buying Bitcoin and kind of storing it on his balance sheet. And I think net that's been a profitable. It's a very strange business. I mean, again, would it be probably cheaper and easy just to buy Bitcoin? If you want to leverage bet on Bitcoin, there are options. You can buy options or you can buy futures. So why does this ETF need to exist? Why does this crazy gambling thing need to exist? Well, exactly as with people who buy Bitcoin ETFs, there are people out there who want to make this absolute crazy leverage bet on Bitcoin, but do not have the access or the capability to do it with options or futures or whatever. So they're going to be frankly, they're going to be retail rather than institutional investors. The chances are that, I hate to say it, but it's quite a high correlation between people who really don't understand markets and people who like Bitcoin. I hate to say it, putting it out there. So they're likely to be less informed retail investors. And I just think this is and I just really worry that they'd be lulled into a false sense of security, because this thing has the ETF imprimatur, so the SEC says you can buy that. The SEC would never let these people trade, huge leverage options on underlying Bitcoin in a million years, but you can do it via this thing. And of course, it's a very profitable business for the people that produce this thing, because obviously MicroStrategy itself operates as a business. That's kind of an extra cost. And also the ETF itself has quite high charges for an ETF. So yeah, just because it's an ETF doesn't mean it's safe.
No, I completely agree, and I discussed this last week with Andrew, and where I also mentioned to him that with ETFs people don't do much due diligence, and so they don't really know how substantial are the companies behind these ETFs running the money, which is very different from the hedge fund industry, where we get really go through a lot of due diligence before people would allocate money to any of our own funds. I think for good order's sake, Rob, I should refer people to, if they want to read more about this strategy or this ETF, they should read an article on Bloomberg from Matt Levine. What he writes about is this Europe-listed 11 million Granite shares 3x long MicroStrategy daily ETP, ticker LMI3. And what he basically writes is that while MicroStrategy itself is higher by more than 100% this year, LMI3 has dropped nearly 82%. And I don't need to say any more. People should go and read it, because that clearly shows how bad you can get burned.
Yeah, this is a specific property of leveraged ETFs that people really need to understand. Now, the fact that this is a European listed as well, again, but this is for people who want to buy a US stock but can't because they're in Europe. So the whole thing is just a way of, frankly, of allowing people to gamble in an arena that they wouldn't otherwise be allowed to gamble in.
Let's move on to our last big topic for today, which is something that came out just after I spoke last week with Andrew. Maybe it's inspired by my conversation with Andrew, because in last week's conversation, Andrew could reveal that, hey, there's a new CTA index, a new SG, SocGen CTA index, even though my understanding now, a few days later, is that it actually is two different parts of SocGen, and it's not the part that normally publishes these SocGen indices that I refer to. This is, anyways, referred to as an investable CTA index, and it is engined by Andrew's DBMF replication model. Now, again, I don't know exactly if the good people over at Transtrend had heard that and said, well, let's put a paper together on this. But nevertheless, they published an interesting paper that you're going to talk a little bit about today. And they titled it, "Can't We Just Buy the Index?" which is very clever, I thought. Tell us a little bit about the paper. What are the key takeaways from your side?
Yeah, it's a very interesting paper. It's been written by Hannah DeBose. He's a smart guy. He knows what he's talking about. It's very well written. He talks a bit about some background about the CTA indices themselves, which is kind of interesting. But I think the thing that's kind of in there that I find quite interesting, and this sort of goes back to this discussion we had about macro momentum and this idea that there's sort of these latent factors that you can't see, and by sort of trend following, you're sort of picking up on those. He's got a similar argument in his, which is that basically a stock index is like owning a bunch of companies, but those companies in turn I don't think he uses the exact phrase, but they're basically exposed economically to various factors. So, for example, he says, if you buy, Toyota, then you're exposed to things like the yen, because it's the yen dollar, because it's a Japanese company. You're exposed to things, like the price of metal potentially. And therefore, by buying a stock index, what you're actually buying is effectively one step removed, exposure to a whole bunch of factors. And he said, well, basically CTA indexes are like that as well, because by buying a CTA index, you're buying essentially a bunch of CTAs, and they are themselves then exposed to, we both trade yen dollar, we both trade various metals, and so on and so forth. So you could potentially do some kind of quant exercise where you sort of try and work out what the exposures of a stock index are in underlying kind of futures space, and then you could actually build an MSCI World Index, alternative index, where you used things like the yen dollar futures price and things like that to kind of back it out. So that's it's a very interesting argument, and I guess the sort of conclusion that he comes to is that the difference between buying a small or a large number of individual CTAs and the difference in buying an index is kind of analogous to the sort of situation with stock indices. And it's not clear to me actually from reading it whether he's pro or anti buying the index as well. I think what he does a quite good job of saying is the difference between is the sort of pros and cons of buying an index of CTAs versus buying individual CTAs. So in very broad terms, if you think you're good at picking winners, if you think you can pick good CTAs either based on their past performance or based on due diligence, then you should probably do that rather than buy an index, right? Because you'll outperform. And if you have sufficient money that you can diversify between, enough of those managers, and because CTA managers are quite correlated, you don't need that many of them to give you a kind of a reasonable theoretical diversification benefit. So if you've got, say, $30, $40, $50 million in the bank, and you think you can pick the best 10 CTA managers, well, you should probably go and do that, right? Rather than just buying the index, and either through replication or some other methodology. So he does quite a good job of outlining the pros and cons of that, which is one of the reasons to read the article. So what I want to come back to is this idea of the fact that stock indices, CTA indices, are basically the same, because I'm afraid I see quite a few holes in that argument, although I kind of like it conceptually. One is that companies actually big companies make a lot of effort to actually hedge out their risks. So, if you go to Tokyo's head office, you'll find a whole bunch of guys working in the Treasury Department trading yen dollar FX contracts, amongst other things. And one of the reasons they're doing that is because they're in their opinion, people who buy Toyota as a stock aren't buying it just as a proxy to bet on the yen dollar rate. They want a lot of that risk to potentially be hedged out. And whether that's true or not, I don't know. But most companies do hedge out their exposure to their principal risk. So oil companies hedge out their exposure to the oil price as much as, to a degree. And companies with operations in different currencies or with particular inputs also try and hedge out their exposure. So that takes away from it slightly. And the other thing is that the difference between, say, Toyota and a CTA is that obviously the kind of exposure that Toyota has to, say, yen dollar or to metal prices is kind of systematic. It's always going to be in one direction pretty much. abstract any hedging activity. But CTAs change their exposure dynamically. Sometimes they're long, sometimes they're short. So although I do kind of buy the argument that potentially there's these latent factors and that any asset you buy, whether it be a stock or a CTA manager, are sort of a bet on those, I don't think it's as simple as saying that, that this is the same underlying set of factors. It's very linear and it's very kind of systematic and in one direction.
If I can just interject here, I'm not sure from memory when I read it, I'm not sure he's saying that they are the same. And I think one of the reasons why they also go on and say that they don't believe that you can just replicate the index, because you can't replicate the diversification that sits within the index. You may get returns that are, highly correlated, but people shouldn't be fooled that they're buying the index, if you know what I mean. I think that's one of their conclusions. And I can't remember if actually he believes that also because of the distinction between, a stock index and a CTA index are not the same things. I mean, we are, you're buying a stock index, you're just taking the price of each stock and that makes up the index every day. But in our case, as you say, we have different strategies, different exposures, and we change our exposure dynamically as well. So it won't be the same. Actually.
Yeah. But so actually this is interesting because it ties into a couple of things. One ties into the debate we have, actually you were having last week and you and I have as well. And you're like, I don't see the evidence that having, say, 250 rather than 50 markets is better.
That's one of my
That's one of your things. I'm in the much more in the more is better camp. And that's one of the reasons why I think replicating with a relatively small number of futures markets is not ideal.
Right.
But we'll talk about that in a second. But it does come. But it's a similar argument in a sense, because just because all the CTA managers in an index might be highly correlated, that doesn't mean correlation's a linear measure, and that doesn't mean that you're you're not going to get these outlier situations where you might happen to hold a CTA that like certain one base in London that begins with an M that just has an explosive year and makes a ton of money. You're going to miss. If you look at their correlation with everybody else, it may still be quite high, but doesn't stop these outliers happening. And these outliers can happen with individual stocks within an index, but they can similarly happen, with managers. And this, the correlation's a poor judge of anything that isn't linear. This stuff definitely is not linear. And also it also means that the kind of idiosyncratic risk, if you happen to pick your own CTAs and you miss out on the one that does really well, the same way that if you pick your own stocks and you've got something that's 95% correlated to the index, but you might miss out on the NVIDIA or does incredibly well because you missed it from your portfolio. I mean, what doesn't help is that the SG CTA index in particular is quite a small index. It's not a big. I don't know about the new one because I haven't looked at it, but the existing one is not. I think is it 10 managers?
Well, the SGCT index is 20 managers, but remember
20.
The new one is not an index of managers; it's a replication model.
Replication of the yes, it's slightly backward. Yeah.
But
even 20 is not a big number for an index. Like most stock indices are much bigger than that. So there's and if your 20 misses out on one of the other CTA managers that's potentially going to do very well, then your index itself will be, in effect, undiversified. But to me, this and the conversation you had last week kind of, really got me thinking about like what the point of all this is. Not in a kind of, what we're wasting our time discussing, but actually it's a more existential point, because I don't think we can really discuss this whole issue around indexing and replication without actually taking a step back and asking ourselves why we're doing it. And last week, Andrew did actually say, well, here's some of the reasons why you might create an index traditionally for things like benchmarking. And also, I think the other reason he gave was effectively to give you a proxy in some kind of asset allocation model to say, well, I'm thinking about adding CTAs. This CTA's only got 5 years of history. I'm going to use this index with 20 years of history as a proxy for the CTA universe, so I can get an idea of what the kind of correlation performance characteristics are. And once I've decided how much I should put into CTAs, then I'll worry about selection later. So that's another reason to have an index potentially. What strikes me about that is that is a very institutional way of thinking about the world. And the whole point about ETFs, as we've been discussing, is they are this fantastic vehicle that can open up the opportunity to invest in something for a retail trader that would not exist without the ETF. And for all of the fact that there's a lot of scary, dodgy ETFs out there, don't get me wrong, I think that's a fantastic thing. And, going back to our earlier question with his $10,000, which we both agreed was probably insufficient to trade futures with, if he has access to an ETF that has a sort of trend following style within it and the fees aren't too bad, that's probably a better use of his money, frankly. And without the ETF, that option will not be available. So this whole kind of source of alternative, risk premium or alternative beta, whatever you want to call it, would not be accessible without ETFs. So ETFs are a good thing for retail investors. So I think we, rather than thinking about a very institutional way of thinking about benchmarking. So institutions love indices, they love benchmarking, they love this kind of stuff. I don't think that's necessarily the right way of thinking about it if you're not an institution. If you're just someone who wants to buy an ETF to get access to the managed future CTA universe, does the concept of an index even matter? Does it really, So, I'm more of a fan of if you are going to replicate CTAs, I'm more of a fan of doing bottom-up replication than top-down. For statistical reasons, replication is not a bad thing. I've no problem with replication. In fact, technically speaking, the way I trade my portfolio is effectively replication. Because what I do is generate positions in 250 futures markets, which about 60 of which I can't trade legally, or because they're not liquid, or because they cost too much money. And out of what's left, I haven't got a big portfolio, and it's got smaller in the last few months. I haven't got a big portfolio, so I can't, if I had $100 million, I could buy positions on my futures. I can't. So I every day I try and replicate that big portfolio with my smaller portfolio. So that I have nothing against the idea of replication. Replication is a good thing to do. I've actually no problem with somebody saying, to fit this particular legal vehicle, this ETF within this usage regulation and whatever that can only hold these assets, I'm going to, with that smaller investment universe, with these restrictions, I'm just going to do the best job I can. There's actually no problem with that at all. But I don't think dogmatically matching an index just because that's what the kind of institutional industry is obsessed with is necessarily for most people who are just want to get exposure to trend following, is necessarily that important.
So just to do justice to Hal's writing, I want to read just 5 lines from the paper itself because I think it ties into what you just said. And then I want to add one more thing, and that is, so Hal writes, this leads us to the question, how can an ETF that trades in fewer than 20 markets deliver CTA index returns? The answer is simple, it cannot. It may produce returns that are highly correlated with the index returns. And in that respect, it is no different from any other trend-following CTA program with the comparable amount of single manager risk, a point that I've made to Andrew many times, actually. But it does not deliver the index returns for that. It simply lacks the diversification that underpins these returns. Okay, so we kind of dealt with that. I want to throw in one more thing and hear your comments before we end. The other thing that I think we need to pay attention to, at least, and that is when something like this happens, and maybe I'm projecting something that may not happen, but it could happen, and that is we now know that the index is based on a long-term backtest of a specific engine to replicate. Okay, fine, sure. However, now that it's labeled an index, and people think, okay, well, I can now go and buy that index, a backtest becomes, quote unquote, a public track record. And for all of us on the manager side, where it's a big no-no to use backtests as a way to sell our products, and I'm pretty sure that Andrew would agree with that. I know he had a discussion with Tim from Auspice about this point, about can you just create an index and then that's your track record, and then you say, yeah, here you go. So I think that opens a slightly different discussion to me that also has some risks in it. Because as you say, as soon as these things become, an ETF product or something sold by a bank, whatever, it becomes more difficult to assess what's really behind it, how was this index created, et cetera, et cetera. So I do think it's worth paying attention to these things.
Definitely. And this isn't a new problem. I mean, I would say I think that probably in terms of like legal regulatory marketing, I would be astonished if they were allowed to put the backtest on the material. And because I think, generally speaking, any product that's offered to a retail investor, you will never see a backtest on it because...
No, but if you publish the index, I don't know that they do.
Yeah,
I mean, it's available on Bloomberg. I think that's public, right? So
it is. Yeah, but it's a tricky one, isn't it? Because I think it'd be a weird one, right? So you can imagine your standard disclosure documents for an ETF. If they said, well, here's the live track record, and here's the index that we're basing it on. I'd need to look at other ETFs that have a similar setup because, of course, there are plenty of there are what I call smart beta indices that do things like, for example, simple FX carry strategies. I think Deutsche Bank have got one. They've been going for a while, and that's an index, of course, which is potentially back tested, blah blah blah. And then, of course, you've got a live track record. I don't know whether the kind of public disclosure documents, the prospectus cover has that back test in the index in it or not. I don't know. I'm not sure. I'm not a legal expert and stuff like that, but I agree with you. Potentially, it's very misleading, even if they're on two different pages. Like and you glance down, you say, "Well, here's the index. This is amazing," and it's an index that's a back test of a strategy. So it's not a new problem because there are already plenty of people that have systematic, actively managed ETF products based on an index. That is not a new thing, and I think in principle it's a good thing, right? I mean, if I wasn't trading my money with my future strategy, and in the future I'll probably go down this route. I potentially would want to buy, some ETFs that give me exposure to different kinds of risk premia that I can't easily access, via just being long stocks and long bonds, which is the other thing that I do. So yeah, it's an interesting development and innovation. And I think the bottom line for me is, as with any ETF product, don't just buy it and think it's safe because it says ETF on the outside. You've really got to understand what's inside this. And that's as true of this new investable CTA index as it is of a 3 times MicroStrategy, ETP. Although of the two, I'd probably have more faith in the CTA index, frankly, than the triple leveraged Bitcoin bet.
Yeah, and in fairness, by the way, I should say that this new index is not going to be officially offered as an ETF. They are looking at it as 2 distinct products, the Andrew product and this index. However, of course, the index is based on Andrew's engine, so there is some overlap. Let's put it that way. Anyways, it's a super interesting development for our industry, evolution for our industry. And whether we are for or against doesn't really matter. It's here, so we need to think about it, and I think this is what these conversations are all about. Good stuff. This was great, Rob. Good to have you back from your holiday, and thanks for sharing all of the insights. Thanks for answering all the questions that came in this week. And of course, if you like these conversations and all the efforts that the co-host put into this, I suggest you go and show that by going to your favorite podcast app and leave a rating and review, because it really does show appreciation for the work that goes into producing these weekly conversations. Next week, I'm joined by Alan, so that will be another fun and insightful conversation, no doubt. I know already roughly what we're going to talk about, and that's going to be interesting, I think, for sure. So make sure if you have questions for Alan, you send them in to info@toptradersunplugged.com, and I'll do my best to bring them up. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week, and in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.